Hello traders, and welcome to another video. In today's video we're going to cover the topic of smart money concepts. Now the term smart money refers to institutional investors such as large banks, hedge funds, or also known as big money that are capable of moving the market in a certain direction retail traders such as you and I are incapable of doing. In this video you're going to learn how to trade like big banks using smart money concepts in regards to the Wyckoff Theory. Now this video is going to be divided into two separate parts. In the first part we're going to have a general view of the Wyckoff Theory, its main parts and its main stages, whereas in the second part we're going to take a deeper dive into a more complex view of the theory, also known as the Wyckoff Schematics. So stay tuned and let's get into the video. Okay guys, welcome to the first section of this video where we are going to have a general explanation of the Wyckoff Theory, its main stages and its main parts. Now first thing you need to know is that according to Wyckoff, the market moves in four different stages, being accumulation, which is consolidation at the lower end, then a mark up, which is basically an uptrend, leading into a distribution, which is consolidation at the higher end, then into mark down, which is basically a downtrend. So in an accumulation phase, it is believed that smart money accumulates buy orders right over here in these areas, pushing price into a mark up, and then where massive sell-off happens in the distribution stage, leading to a mark down. Okay, so this is what the theory evolves around. But this is not always the case. That you need to know is that sometimes the market, and specifically in strong moving trends, we might see accumulation stages leading into what is known as a reaccumulation stage, which is another consolidation stage in a bigger trend, leading into the continuation of the uptrend. Okay, now the main parts of this theory are the law of supply and demand, and this is pretty simple. It means that when demand is greater than the supply, the price would go up, and versus when the supply is greater than the demand, the price would go down. And a very powerful tool to help identify these would be volume bars, but we are going to get into volume bars in the law of effort and result. So the second part of this theory would be the law of cause and effect, and this is self-explanatory, where an area of accumulation leads to a mark up, cause and effect, and the area of distribution leads to a mark down, cause and effect. Just that, as pretty simple as that. So the law of effort and result, and this is where volume bars come into play in conjunction to price action. Now as we said earlier, accumulation is consolidation at the lower end of price action, and in a period of consolidation with high volume, or when you see these massive spikes in volume as you see right here, this is known as the law of effort and result. How much effort is being put into the volume versus what price action is actually doing. So this pretty much acts like a divergence, where volume is high yet price action is flat. So these areas that you need, these are the areas that you need to keep an eye out for, because usually they end up into a mark up phase or an uptrend in case of accumulation. And the fourth and last part of the Wyckoff Theory, and probably the most important part, is known as the spring, or the composite man, or the market manipulator. And the spring happens right here. It is when price action breaks out of a consolidation range, trapping a lot of traders that would open short positions at this point, thinking that the price has broken this range and it would continue to go down, before the market manipulator pushes price into the opposite direction, hitting all these stop losses, all these short traders stop losses in this area right here, adding more fuel to the fire before price action continues its journey into a mark up stage. And we also have the UTAD, or the upthrust after distribution right here, which pretty much acts like the spring, but it traps long traders that think that after this consolidation range is broken, that price would continue to go up before the market manipulator pushes price action in the opposite direction. So this is a very basic, a very simple way of looking at the Wyckoff theory. But later on in this video, we are going to take a deeper dive into a more complicated part of this theory known as the Wyckoff Schematics, and where we are actually going to learn how to trade the Wyckoff method. So stay tuned and let's get to the other section of the video. Okay guys, welcome to the second section of this video, where we are going to cover the Wyckoff schematics and learn how to trade like big banks using smart money concepts in regards to the Wyckoff theory. Now, we are currently in a stage of accumulation, as you see right here in front of you, which consists of 5 different stages all the way from A to E, and the same goes for a distribution phase, but it's upside down, it's on its head. So let's not waste any time, and let's get into this accumulation phase and explain what's going on before jumping onto a real life chart. Now, first thing in the first A, we're going to see that we have what is known as a preliminary support, or PS. At this point, this is where substantial buying begins to provide support after a prolonged down movement. So after a long movement, a sharp movement, we have our first point of support is the preliminary support. Now, after a preliminary support, we have what is known as an SC, or a selling climax. At this point, selling pressure usually reaches its climax and buyers start to get in the market, pushing the market up to these resistance areas right here, causing what is also known as an automatic rally, meaning that the price action would start pushing up into these resistance areas. Now, it doesn't have to be this sharp move up, and you're going to see as we jump into the live chart, it's not as perfect as you see on this drawing. Now, after the automatic rally, we have what is known as a secondary test, or an ST, which price revisits the area of the selling climax right here, just to make sure that the bottom is confirmed right around these areas right here. And after that, we go to phase B, where market would go up and down. And in phase B, we have another secondary test where price does go back down and tests the same area once again. Now, it's not perfect science. It can stop at the same level the previous secondary test in phase A stopped at. It might be a little below it, and it might be a little above it. So there's no perfect science to that. So in phase C, this is the most important phase. It's the phase that has what is known as the spring, or the market manipulator, which is a false breakout that traps traders that open short positions right here. Okay, now this is a thing you need to look out for to confirm you're going through the Wyckoff method, to confirm the Wyckoff scenario. Now, it's very important that you not open long positions right here. Do not be hasty, because there's a lot going and it's not that confirmed yet. You need to wait for what is known as a sign of strength, or an SOS. Now, an SOS is a bullish move, and you need to keep an eye out for volume. You need massive bullish candles in this area right here in phase C and phase D with high volume. And in phase D, you have, after this surge, after the spring occurs, we have what is known as an LPS, or a last point of support. We have a last point of support after price breaks through the resistance level, does this little saw effect right here, retests the resistance level before shooting off into phase E, which is also known as a mark up. So in this area, this is where you would enter your long position, but you always need to look out for the candle that breaks the resistance level. You need a strong bullish candle to break this, with supported with high volume, or relatively high volume. And once it retests the resistance area right here, doing what is known as a backup, or another last point of support, you would enter your position somewhere around here, and you would target a mark up phase. Okay guys, now before we jump to a live chart and take a look at the Wyckoff schematics and learn how to trade them, we're going to have a look at the distribution phase diagram, just the opposite of the accumulation phase. Now right here we have what is known as the preliminary supply, which pretty much acts the same as preliminary support in the accumulation phase, and we have buying climax right here instead of selling climax, followed by what is known as an automatic reaction and a secondary test right here pretty much like the accumulation phase but upside down. And we have here what is known as an up thrust, which pretty much acts pretty much like the secondary test in phase B. So we're revisiting these highs right here, just making sure that this would be the absolute top of it before price continues to go sideways right here. And in phase C, we have what is known as a UTAD, or an up thrust after distribution, which pretty much acts the same way as a string, trapping all the traders that open long positions right here. And as we see this UTAD right here, we need to keep a lookout, just like the spring, that we need to look out until market does this move so we can enter a short position right here. So after a UTAD in phase D right here, we have last point of supply, pretty much like last point of support in the accumulation phase, and we have a long bearish candle that breaks through this supply right here, the supply area, giving us what is known as a sign of weakness instead of sign of strength, as shown on the accumulation phase. And yet again, we have what is known as the saw effect right here, giving us another last point of supply before price shoots and creates what is known as a mark down. So you would enter your position somewhere around these areas. Now let's jump to a live chart and see all this in live action. Okay guys, now that we are on a live chart, we're going to go over the Wyckoff schematics so you can train your eye on how to detect these Wyckoff elements, because they're more difficult to detect on a live chart than on a perfect drawing or a diagram. So as you see in front of you right here, we are in an accumulation phase. We have a markdown stage right here, a downtrend that leads us into this accumulation phase. So without wasting any time, let's start by pointing out these elements and point out our preliminary support right here. So in this scenario, we have 2 points of preliminary support. We can have this as our first point of preliminary support, and this would be our second point. So after a preliminary support, we have what is known as a selling climax. And as we said earlier, in the selling climax, this is where buy orders start to accumulate, pushing the price up into these highs right here, causing what is known as an automatic rally. So we would have our automatic rally set right here. And to end phase A, we have a secondary test that after an automatic rally, the prices would drop down to these areas, revisits these areas. So this would be our secondary test, and this would conclude phase A for us. And in phase B, as we mentioned, that we have one secondary test area that comes down, revisits the areas of the selling climax, just to make sure getting all the way down to these demand zones right here, that would make sure that this would be our absolute bottom for the move. And in phase C right here, we have the most important part of the Wyckoff method, which is known as the spring, or the composite man, or market manipulator, whatever you want to call it. It is the break out of the zone that traps a lot of traders that open short positions in this area, thinking that price would continue to go all the way down after it breaks out of the consolidation stage. But this is the trap that they would get into, and after that, the composite man would push price action in the opposite direction, hitting all these stop losses of these short traders that would have stop losses around these areas. And as we said earlier, adding more fuel to the fire, and as the market moves in the opposite direction. And we have one last thing to point out right here. So this would conclude phase C right here. Phase C, which has the spring, would be concluded around this area right here. And in phase D right now, we have a last point of support, which is the last point before we continue our move upwards. So we have a last point of support right here, revisiting these areas right here. And one thing that you need to keep an eye out for is volume in these areas, because volume tends to be high in these areas, as well as this massive bullish candle that breaks through this resistance area, giving us what is known as SOS, or sign of strength. So at this point, we are almost sure that our Wyckoff scenario has played out very well, and the market would continue to go upward right here. But what you need to keep an eye out for is, as we mentioned earlier, volume and big bullish candles to break through the range. You don't want small candles with no volume, and I don't want you to be hasty, and you should not enter your long position anywhere around here, because your long position should be entered after this saw effect happens right here, where this resistance area is revisited, and we have here what is known as a backup or another last point of support in phase D right here. And this is where you should enter your long position right here and land and ride this move all the way to phase E, which would be our mark up stage. So this is how the Wyckoff scenario plays out. This is how you should trade the Wyckoff, and I always advise that you do not get into any position before the spring occurs, because the spring would be your pivot point that marks your Wyckoff scenario. So you need all these movements to unfold before rushing into a trade. So I hope that helped you. Please like and subscribe, and I wish you the best and good luck.